It's being called the artificial intelligence CapEx boom. Hundreds of billions, soon trillions, are being poured into data centers, chips, and infrastructure to power AI. But here's the catch. To justify that spending, companies like Microsoft, Alphabet, Meta, and Amazon would need to be generating trillions of dollars in new revenue within just a few years. Right now, we're nowhere near that. It's the classic setup for a capital cycle, a boom driven by hype, hope, and fear of missing out. Over the past 18 months, corporate capital spending has exploded. Meta, Microsoft, and Google alone are running at a combined $400 billion annual capex rate, and analysts at Morgan Stanley and McKinsey expect that to rise to $2 to $5 trillion by the end of the decade. That's more, on an annualized, depreciated basis, than the railroad boom of the 1800s, or the dot-com build-out of the early 2000s. Except back then, when you laid steel rail or fiber cable, those assets lasted decades. GPUs, by contrast, last maybe 5 years. Some argue only 2 or 3. Yet companies are treating them as long-lived assets, stretching depreciation schedules to make the books look healthier. It's aggressive accounting in the middle of a gold rush. Big tech companies like Microsoft, Oracle, Google, and Meta built their fortune on being asset light. These were software first, high-margin businesses built on code, not concrete. Now that's changing fast. The Magnificent Seven have gone from spending 4% of revenue on capex a decade ago to nearly 15% today. Meta alone is now spending 35% of its revenue on infrastructure, higher than the average utility company, and even higher than AT&T's spending during the dot-com bubble. When technology companies start to look like electric utilities, with the same capital intensity, but far more risk, investors should take note. History has a pattern. A new technology appears: railroads, telecom, the internet, now AI. Capital floods in. Companies race to outspend one another, believing the winner will take it all. Investors reward them for it. Stocks go up when companies announce billion-dollar data center projects. But over time, the supply of infrastructure outpaces demand. Prices fall, margins collapse, and the companies that built the infrastructure are left holding the bag, just as they were after the railroad mania and the fiber optic boom. The lesson: it's rarely the builders who win, it's the users who come later. After the dot-com crash, internet companies' sales grew 11 times over the next 2 decades. They did fulfill the promise of the internet. But investors didn't see those gains. Their multiples collapsed from 33 times sales to 5 times, and it took nearly 20 years for those stocks to break even. That's the danger today. Even if artificial intelligence changes the world, it doesn't mean investors in the AI boom will profit. Fundamentals can improve while valuations fall, and that's exactly what history suggests happens after every capex mania. So where does that leave us? AI is real, the innovation is real, but so was the internet and the railroads, and they still created massive investment wipeouts. The companies building artificial intelligence infrastructure may not be the ones who profit most. It may be the early adopters, the Caterpillars, the Walmarts, the manufacturers and healthcare firms quietly using AI to work smarter, not just spend bigger. That's what defines every bubble. And this one, the AI capex boom, looks no different. So yes, AI might change everything, but that doesn't mean every investor will win. As history keeps reminding us, in every gold rush, it's the tool makers and the cautious buyers, not the biggest spenders, who survive the bust. Want to know how we trade this major technology trend? At TruthSayer, we trade every single one of the alerts our artificial intelligence generates. As of October 15, 2025, our Valuations AI has outperformed the S&P 500 with a return on investment of 69.07% compared to the S&P 500's return of only 15.6% since we started our AI indices. We've been booking double-digit winning trades one after the other in our valuation strategy, and at a beta of only 0.63 on this strategy and a win rate of 80%, we are giving our members uncorrelated edge. We've kept our members and our own portfolio exposed to the AI trades. If you are interested, you can join the thousands of clients already on our app who are taking advantage of these trades every day. Remember, we trade every one of our alerts our machine learning and an artificial intelligence models generates. Sign up on our website. You won't regret it. Thank you for watching, and don't forget to like and subscribe.